Okay, guys, welcome. Thank you for joining us this evening. My name is Roy Maddox. My partner, who is also my son, Wesley Maddox, is hosting this meetup with me today. We've been doing these for years now, and we meet the second Tuesday of the month at 7 o'clock p.m. The meeting tonight will go until 9 p.m. tonight, just to give you an idea if you haven't attended one of these meetups before. We'll go from 7 to 9. We'll do an hour from 7 to 8, take a break. We'll basically be talking about the market, some investment principles, background. We'll give you a sense of how the market's performing, what's the breadth like, what's the technical action like. We'll talk about some fundamental factors. We think we'll take you through a great slide deck that you can keep and refer to and learn from. And so we'll get that out to you if you're on our email list. So Wes will drop the link to get you started if you're not on our list, and we'll be happy to share that out with you. On this front page, you'll see our contact information. So if you would need to reach out to Wes or myself, you can follow us on Twitter at Roy L. Maddox or Wesley J. Maddox. And we're portfolio managers for a firm here in Charlotte, North Carolina, Integrated Financial Strategies, where we manage money for individual accounts all across the country. And in some parts of the world, we've got clients in other countries as well. So just to give you a little background, I've been trading since 1987. I met William O'Neill, Bill O'Neill, and David Ryan in 1988 at a seminar in Houston, Texas. And I was a rookie back then, but really that changed my life, and it gave me the fundamental and technical background that I needed to learn that I needed to adapt to build a framework to invest in the market. And as far as I am concerned, CANSLIM, this process, is the best investment style over time to significantly beat the indexes. So we wanted to welcome you tonight. This meetup we've got over 3,000 members, close to 3,000 members in this meetup, and we're thrilled to have you tonight. We'll cover a wide range of topics again, and we hope that you enjoy it. Thank you for joining us. If you've got any questions, be sure and stop us throughout the presentation. We'll be happy to answer those. But we're excited to give you a background, give you some information regarding the overall market trend, which is very important. And then the second half of the program, we'll actually show you what we own and our buy list and our focus list of what you might want to be considering and concentrating in, because our forte is to identify the true market leaders, and we'll share some of those with you tonight. So let's get going. This is a little bit of information about our meetup group. So again, you can follow us on Twitter, where we're prominent. You can also listen to a number of interviews that we've had on our YouTube channel and through Richard Moglen and his group at Trader Lion. You can find us all over the web. Of course, tonight we won't be providing any specific individual advice. This is of course, for education purposes only. Now, CANSLIM, for many of the members here that are on the call tonight, you're very familiar with the acronym CANSLIM. And this acronym is covered in depth in William O'Neill's book, How to Make Money in Stocks, which is one of the best-selling books that's ever been written on the stock market. A great primer for both novices and advanced investors and traders as well. Okay, a process overview. We'd like to begin the presentation by talking about the three legs of the stool in terms of having an investment process. We think that consists of employing technical analysis, fundamental analysis, and being aware, being macro aware of what's going on in the economy as well. We think you need all three of these legs in the stool to develop a consistent investment process. Technical analysis, many of you are familiar with some of these technical indicators, such as MACD, that's the moving average convergence divergence indicator, price phase, stochastics. We'll talk a little bit about the trend, and that's really the most important concept in terms of if you're a trend follower, which we are. So we identify the trend from a short-term basis as being positive when the 10-day exponential moving average is above the 21-day exponential moving average. And the intermediate trend, we deem that as positive when the 21-day is above the 50-day moving average. That's the simple. And of course, the long-term trend we believe is positive when the indexes are trading above their 30-week moving average. And this is well equipped us over the decades to keep us on the right side of the trend. And that's half the battle. And we'll be talking about how where the trend is today, and that's very, very important. We're right on the cusp. We've had this correction. We're right on the cusp of either breaking down or making the next leg higher. And the next few days will probably give us direction one way or another. The breadth, we're looking at things like the percentage of stocks above their moving average. We think that's useful because it gives you an idea of the health, the overall health of the market, not looking at just the indexes, but looking at the broad market. Again, today we'll take a look at the RSP, which is the equal weighted averages, and those are holding up much better than the S&P and the NASDAQ. So we think that's quite positive as well. We'll take a look at the advanced decline line. And we also think it's highly important to look at and consider what's going on with new highs and new lows in the market today. There has been an increase in new lows over the last few days, and you'd like to see that dry up, and that's going to have to dry up to make the next leg higher and bring the overall market with us. In sentiment, we look at things like the National Active Association of Individual Managers index to see, well, what kind of cash position do they have? What kind of investment position are they currently in? We think that gives you highly useful information. We'll talk a little bit about the put-call ratio in the VIX, which just signaled, a climactic bottom a month or so ago. We think that's very useful as well. We might talk a little bit about ratio analysis as we consider, well, are small caps outperforming large cap? What about growth versus value? What about the stock market versus the treasury market? So that's some important concepts that we'll cover tonight as well. And again, this is CANSLIM. CANSLIM that was developed by a study by Bill O'Neill has consistently allowed you to focus and screen for the true market leaders, those stocks that can go up 100, 200% or more over a period of 6 to 8 earnings cycles. It's been shown, and in fact, in Bill's book, How to Make Money in Stocks, you have 100 charts that show all the great winning stocks in the past. So, so you can take a look at that. A picture's worth 1,000 words. And really, the key to investing in the market successfully is finding what works, following the institutional money, and then having uh, prior episodes, prior market history to look at, so that you can decide sort of where we are in the market cycle, and what are these stocks, what do they have in common that other great winning stocks had in the past as well. We think that's important to look at that. The macroeconomic analysis, we do subscribe to Hedge Eye Research, if for nothing more than just to give us some feedback with what's happening in the economy. And we think that interest rates are really, really important. And we think that, of course, GDP, and if the market is, is the economy growing, we think that's important. Tomorrow, we're going to have I believe the CPI that's reported at 8:30, and then the PPI will be reported the next day, and that will give us some clarity in terms of, probably, is the Fed going to lower interest rates 25 basis points, 1/4 of 1%, or 1/2 of 1% next week, which is a certainty that they are going to do something for the first time, in a number of years. And with that, let me turn it over to Wes now, and Wes will take you through the rest of the slide deck, and then I'll come in when we've gone through the slide deck, and then we'll pull up individual stocks, and we'll look at the market, and we'll look at some tools that we have to try to identify, well, what do we need to be doing now? What's going to provide the best opportunities? And we think that there are a number of those that are forming right here. We're quite optimistic, particularly if the market can recapture the last week in terms of the drop in the last week. But we do need to recapture the 21-day and the 50-day before we're firmly back in the green in terms of everything, the train coming in in the station appropriately. So with that, let me turn it over to Wes, and Wes, take us through the slide deck, please.
All right. Thank you for the intro. Oops. All right. Yeah, I'll go through this. I'm going to keep updating this for the next, well, really just one more month, right? But we have this betting odds. I like to look at this as my best source of, what are the odds of the election coming up? What's the, where's the money going for that, to see what that market for betting is pricing in. You can see, the last week or two, a little bit of a bump in Trump's odds there, but we'll see what happens with this debate. Obviously, there's some potential for this to have a big move. We know what happened. The last debate, there was a pretty clear victor, and it actually had an impact, right, where Biden decided to step down. But anyways, it'll be nice to see tonight. Hopefully they're cordial and discuss things that people care about. But anyways, here we are. Here are the odds the day of the debate. Okay, and once again, CPI is coming up, and just wanted to put out, the estimates that I'm seeing. This is from the Fed's estimates for the next couple of months. So they're looking for 2.6% year over year in the CPI. That's the blue line there. The PCE is that orange dotted line, and that's already that's a little bit closer to 2% already. So that's maybe, I think that's 2.2% in the next month, and then 2.1% in September. So clearly, really getting close to that 2% target. And it's they obviously are going to have to cut because the longer they wait, the more likely they're going to overshoot it. And I think that that's the bigger risk right now is the overshooting um, of that. I think the market's dealing with that and trying to figure out how much they might overshoot that target to the downside. Um, but one reason why I think that, and I think it's clear, is because I've been looking at this too from the same website, the Cleveland Fed nowcast for inflation, and I'm looking at this quarter over quarter annualized rate. Um, it's the same way that they measure GDP, where they look, quarter to quarter, and then of course back into a 4 quarter sort of annual growth rate. This is actually the number. This slide is showing the number from a month ago. So this is showing the August number when we had the meeting. I just kept it in here. But you'll notice the CPI is showing under 2% on this basis of measurement for the third quarter, and the PCE at 2%. Now updated for today, that's come down dramatically over the last 30 days. So you can see the quarterly annualized rate is 1.2% for the CPI and 1.5% for the PCE. And so, that to me, I think is super important, right? They make policy based off of the GDP growth, and, quarterly. Just, they should make policy potentially based off of this same thing. It's, a little bit more timely. It doesn't get into the comps as much, right? Where maybe you were, dealing with a weird oil price in September, but it was an easier oil price comparison in July. It smooths out a little bit of that stuff. That might throw a wrench into comparisons on a year-over-year basis. So I'm looking at this and I'm thinking, wow, they really, I don't, I think 25 is a little low to get started. I think they need to acknowledge, what the current data is really saying about inflation. To me, this quarterly number is telling you that the precipitous decline is telling you something else. And then just as far as the GDP growth and everything, we'll talk about that and we'll talk about unemployment, obviously, too, because that's really been the confusing um, part of the data that's coming out, the weakening, and is that good or is it bad, right? It's hard to understand. But I look at this leading economic index. We had this downward blip, right? Very small downward blip in the most recent reading on this leading economic index. And you wonder if that's kind of if the market is sort of is getting jittery, right? Because of certain things that we're seeing in the economy. And that looks like just a tiny little blip. We will see obviously what happens from here, but um, to me, longer term trend and growth, not necessarily um, a problem. But then again, we just got to be aware if there are cracks starting to show, um, in the economy. And so again, looking at the Fed's projections, there's not a whole lot of panic. This 2 to 3% growth rate. This is like a really good spot to be for our economy. It's not too hot. It's not too cold. If it gets too hot, then we have to worry about the Fed tightening and all that. And if we get too cold, of course, then you worry about recession and everything. And so I think the reason why recession talk is coming up more and more is because we're seeing the weakening in the labor market, and we had a few data points this week, or actually I guess last week, that showed that. And so obviously, the question is, are they going to cut? Will they cut by enough? Will it be enough to avoid a further deterioration in the labor market? We got this report on Wednesday, the JOLTS job openings report. It's put out monthly. Anyways, it talks about how many job openings there are. So, when there's a surplus of job openings, a really high number of job openings, of course, there's really high demand for those jobs. So that would equate to a very hot labor market, right? And that's where we had that wage pressure to the upside, where maybe wages peaked at probably 5% or I can't remember exactly, but well above the average range. Now, I just drew this simple red trend line here to say, okay, where are we versus where we should be over the long-term trend? Well, we're in a much looser labor market based on this, and you can kind of see where it normalized was in the middle of 2023. is when that you could say that normalized, especially based on this metric. Um, so clearly softer. We talked about this particular SOM rule or SAM rule. Not totally sure how to say it, but we talked about this last month too. And this is kind of at the top of my mind. I think at the top of a lot of people's minds about if they get this sort of escape velocity um, of unemployment rate increasing. So this is a look at the unemployment rate, by the way, on the y-axis, and then years on the x-axis, and then these gray shaded areas are recessions. And so, this chart is basically showing that historically, when you have this, you can look into the calculation exactly about how this is done, but basically, when you have a half percentage point increase in unemployment over a certain period of time, over like a year, um, you kind of see this. It's kind of the beginning of maybe like a waterfall, right? Of layoffs, right? Layoffs that beget layoffs. So to me, I'm looking at this not necessarily has to be a huge indicator, but obviously the market's going to be way ahead of this anyways, right? In retrospect, we're gonna see whether or not it comes true, but it's a risk, and I think that people are aware of it, and so I want to be aware of that too, because that's the danger of these things. It's not always linear, or it's never linear. Clearly, right? The economy doesn't shrink in a linear fashion. When it does shrink, it accelerates the downside. So keep this in the back of your mind. Um, and just always be ready for the downside of the trade. And like Roy mentioned, we think we're looking at these charts, and we're really in a no man's land as far as we might break lower, or maybe we get good data, and in a day or two, maybe in a week or two, we're back above all the averages and the trend is repaired to the upside. It's unclear, but anyways, keep this in mind. Keep this in mind, and this other thing we saw today was interesting. More cracks, right? We're just looking for cracks. We want to know, if we need to be worried. Obviously, there you shouldn't probably be fully invested right now. We see the indexes that are looking heavy, and possible deterioration in the trend already. Um, and this was a shot across the economy that a lot of people heard and impacted a number of financial institutions today as far as their stock prices. This is a quote from the Ally Financial CFO. They're really heavily involved in car loans, so they're a little bit specialized in that regard, right? Like JP Morgan, who did get kind of hit today. It doesn't necessarily have that high concentration. I think Ally is well known to have a large auto loan book, but you can see there's a couple of these highlighted statements here where they're talking about delinquencies up a little bit higher than their expectations, and so it doesn't sound like a lot. 20 basis points and 10 basis points of net charge-offs higher than their expectations. It doesn't sound like a lot, but it's just something to monitor. You don't want to see that trend to continue, but clearly they're seeing it in their auto loan book, and it must be because of unemployment increasing, right? Of course, that has an impact on these things. And here's a look what I was talking about, the break in financials. A look at a few charts over the last couple of months, but for today, you see Ally Financial down 17.6% on the back of those comments that they made at a conference. There was a couple of the auto companies, same thing here. That's all on this row, the auto companies that really could arguably be just financial institutions that sell cars. So they have a loan book as well that you've got to that you got to pay attention to for their earnings. You can see that a lot of these companies though did recover, actually. They didn't have horrible closes like Ally. So maybe it's a little bit of a specialized comment more so than something you got to look for across the board. And then JP Morgan, kind of the weakest of these other major companies that we're looking at on this page. today. But I heard that one of their comments was about lower net interest income. Maybe it's kind of you know, um, the final realization. Okay, net interest income, obviously a huge part of these businesses, um, is going to go down, right? As the 10-year comes down, the 30-year, the longer end of the curve comes down. Of course, that's going to have a negative impact to their earnings outlook. So tough to say, but anyways, something that resonated, I think, for a lot of people was hearing that maybe it's just we'll see, but it's the first kind of crack that we're seeing in consumers potentially with that increase in unemployment that we just talked about. And so, with that, this is the chart we're looking at. Tomorrow, we're going to see, you know, probably get some more clarity about what the Fed's going to do next week for the Fed funds rate. Right now, it's more likely that they're doing a 25 basis point cut versus the 50 basis point cut. Um, but there's going to be a lot more information out there, important information for them tomorrow with the CPI. And I don't know. I don't know what they're going to do, obviously, but to me, I think there's more risk of them doing too little. I think the higher risk is that they do too little to get started. Right? I don't think it's a big deal if they do too much, but if they do too little, then it kind of makes you wonder if they're paying attention to the same things that we all are on this meeting.
Wes, let me
And
point
so
out
here's just
as
a look
well.
at the path of the 1 year and the 2 year U.S. Treasury rates. Um, this is basically mapping out the trajectory that the market is giving them for the interest rate um, over the next 1 and 2 years. Right, so this is at the 1 year hit 4%. That's the lowest in a couple of years now, and so they're clearly seeing the same things. We're seeing the inflation fall, quite a bit, and clearly, the risk is moving, and the Fed's been talking about this for the last couple of meetings. The risks have been balanced. Now I think clearly the risks have shifted, um, without a doubt into the labor weakening camp. So, continue to see these things fall. I wouldn't be surprised to see these fall further. And the 10-year right here at 3.6% today at the close. That's probably going to come in a little bit lower too. And Roy and I were talking about this. Not that we need a target, but the first target you look at, okay, it's got to go to 3.5. And to me, I just think 3% makes a lot of sense over the next 6 to 12 months for this 10-year rate, which would just be 1% above inflation. So I think this has more room to go too. And yeah, I mean, I think that Treasury bills have been such an attractive alternative for the last few years. Maybe we actually begin to see that shift with further declines in those rates. Okay, now out of the macro and sort of just in our regular charts that we look at, here's the Nasdaq and the MACD. The MACD had a it's a momentum indicator, and that hit a sell signal, I think September 1st. So with that big break, right? And if you're only invested in the indexes and not individual stocks, to us that really is a sell signal. Um, if this was the stock you own, that's clear. It's a clear sell signal. The MACD turned. You broke the 50. It should have held right here, right? It had every opportunity to hold and turn higher. It did not. It broke, and now you're getting confirmation with the 10-day below the 21-day, and getting a little bit of a bounce here as well. But anyways, this is kind of what you're dealing with is okay. We're going to talk about the stocks we still own, the stocks that have held up, but understanding okay, the indexes do look a little bit ominous, but we can't really. We're doing our best to kind of ignore the indexes to some extent and just hold what we have if it's working and holding up. So Clearly, though, on the index level, we're getting a number of signals that that things have declined. You got this major bottom here, rally up, and then turn down. Now the 50 days turning down. So I'll actually skip to here to get you a better look at the moving averages. But um, the trend starting to improve right in the middle of August, saying, okay, maybe that was just some wild yen fueled, Japanese fueled panic and dislocation in the market, and then big rally back, a key reversal day here, and then yeah, like we mentioned, just a closer look. The 50 days turning down, the 10-day below the 21-day just a few days ago. Definitely another signal that things have deteriorated. Um, in the trend. So, right here, it's tough to say because it feels like you're right in the middle of the 50 and the 200, right? So you think the 200 support, the 50 maybe is resistance. Um, I don't know. It's there's not a whole lot to glean, I don't think, from here, right in this particular location. It's really hard to say where the upside and downside and from a trading perspective looks relatively balanced. And okay, so we usually just look at the Nasdaq, honestly, but I wanted to show the S&P as well. Just it's been the stronger of the indexes, so you can tell, just at this chart versus this chart, right? You have the 50-day, which is still sort of moving, barely moving up. You can see how close we are to the 50-day. You can see the 10-day just crossed below the 21-day. And we were talking about how, a lot of times these trends they look like they're just about to break, and then, if we just happen to have a pretty good day tomorrow. Um, this index could be up what 500 points and not 500, but like 200 points tomorrow, and then we're talking about, okay, maybe the trend can actually continue upward. So the S&P just much stronger portion of or part of the market right now. More diversity, less tech, more staples, utilities, REITs. Those things that we've seen outperform for the better part of 2 months, really. And then looking at this long term trend, real long term, this is the Nasdaq weekly versus the 30-week moving average. We talked about this a whole lot back in the bear market when we were consistently below this 30-week moving average for the whole year, really. And so, we've kind of held that. We look for two closes below or two closes above to sort of signify a change in trend. We got a scare, back in August where it actually closed above the 30-week. We had it closed slightly below last week, so we don't want to see, 2 weeks below. That's going to raise some alarms if we start living below that 30-week moving average. But for now, we found it kind of found support from last week at this 30-week average, and had a bounce so far. So, the long-term trend appears to be intact, based on that measure. Okay, and we'll talk a little bit about breadth here too. Breadth it's really just been lacking. There's not a whole lot to say. I don't feel like where it is right now. It's at 64% of stocks above the 50-day in this chart. That's looking at the S&P 500. 64% of stocks are above the 50. That's sort of a very average level. I don't think tells us a whole lot about it's neither under or oversold or overbought. And then looking at the stocks above their 200-day, that continues to just range bound in this 70%-ish range on the S&P. The Nasdaq shows that weaker picture, and of course that is where we traffic more in some of these tech stocks. That's often where we're seeing those growth numbers. So we're trafficking in those Nasdaq stocks, but that has been the weakest index throughout 2024, ever since we had that real good start to the bull market in November of 2023. It's kind of slowly just lacked the participation, even while the index is sort of plowed higher, um, generally these last 8 or 9 months. And here's the NASDAQ stocks above their 200-day. Really shows the same thing versus the 50-day. Only 40 stocks, or only 40% of stocks in the NASDAQ are above their 200-day. So that's only 40% of stocks. In uptrends, based on that measure, we had a brief moment in July where, it looked like breadth was going to resolve itself to the upside. And then, of course, a wicked reversal of that early August with, kind of a fake breakout in the Russell, a fake breakout in the mid caps. And, here we are back again, just trying to consolidate until we get more clarity and more participation. Okay, and here's a look at the NASDAQ and net new highs. We've had these, episodic periods where we're making more new highs than new lows. Currently we're in this net new low period where lows are outpacing highs. So yeah, again, the NASDAQ just it's been a trickier index to be a part of or to trade in those stocks. It's interesting to see that the New York Composite index, you can see a little bit more of a consistent net new high number throughout the last 10 months or so. So yeah, back in November when we kind of consider the bull market to really have started, yeah, this has been a very consistent index, a little bit different weightings of industries and lower volatility and lower upside too to some extent, but it's been a more consistent and sort of balanced index on this measure. And okay, our preferred oscillator being the McClellan oscillator shows you, okay, we were on this is the New York Stock Exchange McClellan oscillator. We weren't quite oversold just a few days ago, but we were overbought. And this is probably the NVIDIA day where we were overbought one more day and then came in. The NASDAQ from this oscillator perspective, we did hit that oversold level, that threshold of -40. And so, we are seeing that bounce. We'll see, again, we like I said, with the indexes and Roy has mentioned, we're in this area where, we could resolve ourselves to the upside, or we could come in for a leg lower, hit the 200-day and find support. So, you're going to see this become quite oversold. If we do come into that 200-day in the NASDAQ, we're definitely going to see this.
Wes, let me
get down here to that -60 level. Yep.
Wes,
Roy?
Wes, let me
Yeah.
make a comment here if I could.
Mm-hmm.
Okay, so guys, we're looking at the averages here, and we're looking at what individual stocks are doing, trying to find and cherry pick those that are holding up the best, that are going to lead this market to the next up leg when we have it. And so this is the art of, trying to determine, our exposure, position sizing, how many positions should you have, what's the size of those positions, and how do you protect your downside. Now, when and we'll take a look again at the NASDAQ and the S&P, but we put in a low 2 days ago. And we're looking at that, and we're of course noting that the McClellan oscillator, hit in the NASDAQ, it hit over an oversold area. So we're right at the point where we can begin, the next up leg, or we take out the low of 2 days ago, and we shake out one more time. And there's no way of knowing that ahead of time what's going to happen. Again, there's a good chance that we just had the correction, this recent correction, and the low was 2 days ago, because we are seeing some buying in the groups, and a lot of technology stocks that are way oversold, that have corrected particularly in the semiconductor space. And so, it's important to look at that. But, we are the short term indicators are, they're leaning bearish or negative, but we're right on the cusp where they can flip, with one or two good days. So you're going to see everything probably get resolved, in the next couple of days. But we are in this seasonally weak period of time, of course, September and October. So we're contending with that, as well. But it is quite possible, that the market confounds what most people think, and we bottomed 2 days ago, and then we trek higher over the next couple of months, leading into year end. And we think that is quite possible, because if we're not in a recession, there's nothing more bullish than to have the Fed on the same side of the table as you. So we have clearly seen over the last 9 bear markets and recessions that we've had, that the market does well if we don't go into recession, but we just have a correction, and the Fed's stimulating the economy by lowering interest rates. So that's quite a bit of fuel that we have, and so we got the Fed put in our back pocket, but we just don't see the economy coming unglued, because of, I guess, the nature, how diverse our economy is, and the growth that these individual companies that are producing. We're having GDP. GDP is that's running right around the 2% area, and normally a recession has 2 consecutive quarters of negative GDP. And we think that the market's going to avoid that the economy is going to avoid that. So that's going to give a bullish undertone. And maybe that's why the market bottomed 2 days ago. And because the market senses that, and we'll just have to wait and see. But when we look at our individual stocks, you can see that, you've got great places to put stops over the last couple of days. And, we'll just see how it turns out, in the next few days.
All right, thank you. Yep. Yeah, you mentioned that there's some buying in some of these stocks, and with AI leading the whole market, basically the whole narrative, the actual investments there, like AVGO, that comes to mind. That was some serious buying. Hopefully, putting in the low, like you mentioned there, just as an example. Okay, and here's the VIX. More, some sentiment stuff. The VIX, we know it spiked at 65 a few weeks ago. Seeing some more fear percolate right at the start of September, right when everyone's saying weakest month of the year coming up, and right on cue, a little pickup in VIX and fear with the pullback in the market. So it's a pretty rough start to September. But the good news is, if it's a normal September, then the damage is definitely behind us.
And
Here's a look at the long-term VIX.
yeah, oh,
What
perfect.
was that?
Perfect. I
Okay.
wanted to, I didn't know that we had this chart, so that's great. Yeah. So carry
Uh-huh.
on. This is the third biggest spike in the last 20 years. So
Yeah, exactly. So huge spike. Crazy day there, and you think, okay, you think if it's behind us, that's a very, very, very meaningful low. Hard to imagine us undercutting, and an area that just was absolute panic a month ago. So I think that bodes well for a really good low being put in, and at this point, to recheck that low in the Nasdaq might be another 5%, but I don't think that necessarily has to happen. Given what happened just a month ago. Um, okay, and so this is the active manager exposure index down here. And you can see we're at about 71% long based on that survey. That's active managers tell people how long they are. 71%. Um, that's not again, that's kind of like the trend. It's sort of in a no man's land territory. We've seen historically, okay, bigger than 100%, that's a big deal. That's a sign of of a potential top, at least short-term top. That's done a pretty good job historically there. And then levels near, I'd say below 40, often put in a good low. So right here, you have fuel to the upside and fuel to the downside, potentially, and based on that index. The Bulls and Bears, I don't think there's much to say here. The Bears have been, pretty low since the start of the bull market, as you'd expect. And Bulls are, oscillating from 45 to 50 or 40 to 50 throughout this whole year. It just you continue to see this sort of 51% level being a little excessive, and pullbacks right there. But right here, we're at 45, kind of average where we've been for the last 10 months. Okay, and this is a long-term net number, but just for your reference, this put call ratio, the level of fear that we see in this, we saw it spike, not exactly a massive spike that we saw at other really good lows in the market, but I think it was just so quick that the 5-day average, didn't necessarily have time to peak because it just was such a swift, um, 3-day pullback there. We see this at the sort of neutral level as well. But we welcome this uptick. We welcome fear, obviously, to signal that maybe you can put in that low like we're talking about. And here's a look at the equity put call ratio, just a specific part of the put call ratio market out there. So this is spiking. I guess what's a little interesting is you kind of see how much on the total basis of puts and calls out there. Um, that's still well below that August low. Just looking at the equities, we're a lot closer to that August low. So, just there's no complacency built in here. We don't think at this level, so that's nice to see. On this ratio. And so we talked about credit, we talked about Ally, we talked about some of those banks getting hit today, and that does coincide with a little pickup in high yield spreads. So this is that measure of credit risk that we always look at. The higher credit risk, the higher these high yield spreads go. And so we did see an uptick there. Hopefully not indicative of something more ominous to come, but it's popping up on people's radars. It's popping up on ours. We see the unemployment rate going up. That would naturally lead to some deteriorating credit quality. Of course it would. That's just what happens. The real question is, okay, does it stabilize versus get away from us? But we're keeping an eye at the credit markets. Again, important part of it. Keep an eye on those banks, see how they react over the next week or two, see if they shake it off, right? If JP Morgan, rallies from here and that's the low, maybe, right? And that would be a very good sign of health in the banks, and maybe an overreaction that could happen today. Okay, we've got a few more, but I wanted to point this out too. The All World Index we maybe looked at a couple of weeks ago or a couple months ago. This is really hovering near all-time highs. I was more hopeful just a couple months ago that we were off to the races on this initial kind of breakout to new highs. We had a wrench thrown at us in August, but here we are, new highs again across the world, and this sort of normal pullback now. So, we're on the cusp, perhaps of an actual, real high participation bull market with the Fed at our back, and with this kind of global market action. I think this is encouraging. Here's a look at Bitcoin. One of those tricky assets that's gone sideways for a lot of this year. after really kicking into gear back in October, so a year ago. Continues to just consolidate. It's been tough to trade this year, but constantly looking for these spikes down and recoveries. Often a good opportunity when you have these high volume down days to sort of buy panic in this asset. Um, Here's a look at oil. Just on the inflation trend, wanted to include this. We saw a big breakdown in oil the last couple of weeks too. And I think that's fueling a lot of the lower inflation expectations that we're seeing in those forecasts we looked at earlier. So this certainly bodes well for more Fed action if there's ever been. I mean, there's not a doubt about that they're going to cut next week, but it certainly gives them a little bit of cover. Even more so just when worst case scenario is that for some odd reason inflation re-accelerates while the economy deteriorates. I honestly don't think that's possible. Um, but anyways, just more confirmation that okay, they are going to cut, and to me, 50 basis points I think seems safe. Seems safer, and we'll see if the market will agree with me later. But um, we'll see. Uh, last thing here is gold. Yeah, I pulled this up. This has been something, we've been looking at on a monthly basis over and over and over again, because of this, beautiful base, right? It's gone sideways for 13 years and got that breakout in like February or March. I guess that was March of this year. Well, it had a great run over 6 weeks, has really, consolidated, just like the market for 5, 6 months here. And to me, this is getting to be, like a very, very tight setup. It looks, a Mark Minervini VCP kind of setup right here. And we've got this day tomorrow, which could happen to be a catalyst to push gold into new highs, and continue, the move upward. So to me, I thought this was important to include because I think it looks like a very compelling setup, based on how we look at things. And one of the things you're going to want to do is, okay, if you buy at 234 right into new highs, if it gaps up and then we reverse and close down, I mean that to me would be an expectation breaker. um that'd be maybe a news failure, right? If we go higher based on lower inflation and lower interest rates and gold gaps up and closes lower, that'd be a warning sign. But anyways, looks like a great setup to me personally. Obviously, it looks a lot stronger than equity markets right now. So, it doesn't really matter what we buy. This looks like a good one to me. And you have this massive long-term move potential too that we could just be getting started. Okay, and that is all. That's all I have, and I can throw it back to Roy.
Okay, guys, are there any questions regarding the overall market? Kind of what's going on there? What are you guys seeing? Do you have any? Would anyone like to provide some input?
Yeah, I have one question regarding the bond prices. Bond market is a smart one. When the bond prices are going up, market is warm. They like to be paid. They would like to get their money back. So now you're showing being optimistic from the equity side, but the bond market is not giving you green signal. How would you interpret this one?
With the bond market?
Yes, bond prices, 30-year bond prices, they are going up.
Yeah, yeah. I think. Well, I mean, there's a couple of reasons why bonds go up. I mean, it could be what's hard for me, or when you see negative employment rate data, it's unclear, right, if that's positive for equities because, okay, rates are coming down, but they're coming down for a bad reason. If bonds are going up because of slowing inflation, I think that's a positive thing for both, for sure. But I don't, I mean, it's just, maybe it's just the time, the market is tough discounting mechanism, and it's, we've all been expecting lower rates, but and lower inflation, and it's just a matter of when. So maybe, I don't know, maybe the rate decline is just getting started because we're really going to be convinced, the market's finally going to be convinced that this inflation story is over. The bond market, I don't think was able to let rates get too low in the past, because as soon as the rates get too low, then commodities go up. So it's this gyrating motion. But maybe this is the report that the bond market is now expecting to be the nail in the coffin on this whole inflation story, and really seal the deal. So if it's an inflation fueled thing, great. But we'll know within a couple of weeks, I think, if it's something sinister. We'll see it in the equities shortly.
Now, there's nothing more bullish than having everything work, the bond market working and the equity market working as well. So you can see I've got a chart. Are you guys seeing this, my chart here on the TLT? Yeah. Okay. So you can see here that, we've had this dramatic drop in bond prices, over the last, 3 to 4 years. And now we're having that uptick in bond prices as rates come down. So it is quite, it's quite possible. And, we really expect bonds to do well and stocks to do well. But of course, bonds are a competing investment, instrument. And the bond market is, of course, much larger than the equity market as well. So it's a matter of, is the tail wagging the dog or not? And so that's just that's just kind of the background with what we're looking at right now. But it is, we expect rates to go lower, bonds to go higher, and we expect the equity market to benefit from that, unless we we get into a full-fledged negative, nasty recession, which we don't see. But the indexes and the equity market and the stocks will kick you out. You don't need to predict that. You just need to react based on what, based on based on the information, based on how the market's reacting. That's the most important thing. And so that's how we're playing it.
My understanding is like Fed controls the short-term interest rate, which is a very short.
Yeah.
But the market controls the TNX, which is a 10-year, because most businesses borrow at the 10-year. And the 20 to 30 year, they are more reflective of the price stability in the market rather than reflection of inflation or Fed fund rate, things like that.
You're right. I mean, you're right. The Fed controls the short-term rate, and that's the Fed funds future. So, that's going to have more of an impact between, the 1 to 2, 3 year rates, while the long bond is going to be affected by market expectations, growth expectations, and the market determines that from the 10 to the 30 year. So, again, that's that's sort of what we're seeing right now. We're looking at the interest rate cycle, and we certainly see where there's, the next levels of support are really at that 3.0 area in the 10-year, and 2.5. We'll see where we go, and the market's gonna have to achieve equilibrium, but we don't know what that equilibrium level is going to be until we get more economic news and we have the Fed that's actually doing something. And that will all play out in time.
Ed, a quick question for you guys. I know that you subscribe to Hedgeye. Which subscriptions do you guys have, and how helpful do you find it? He's been wrong a lot, and
not especially helpful.
Yeah. Okay.
But, we found that and again, the macro backdrop is just so difficult to predict, and it's it's a small part of what we're looking at when we look at the macro. Like who's the president? That's a macro, qualitative, piece of information. And, we just don't think that any of that stuff is really that important. But we think that the Fed is really the most important. That's really what we're looking at growth. And then what's the Fed actually, what are they doing? That's the most important thing that we focus on the macro side. But,
I find that I could discount a lot of his influence. He's a pretty opinionated guy, and it's like in looking
yeah,
at the cards, I have to actively discount what he says, which it almost seems like more of a hindrance for me. But it's just me.
it can be a distraction. So
Yeah,
we're aware, and he does provide great macro data, but we really don't invest the companies that we're buying, that we invest. It's really, you don't have that much of a macro impact. Like, the companies that we're in, of course, that we're in now, they're not going to be impacted that much based on where interest rates are. It's more the demand for their services and what are their earnings prospects. That's the most important thing. You always get back to those companies that have powerful and expanded, earnings, margins, revenue growth, return on equity. Those are the things that really drive, stock prices.
yeah. Thank you.
You're welcome. So let's take a look, guys, and just to give you an idea. And by the way, this is the weekly. So you can see here on the weekly, and realize that we just had the worst week in a number of years. The first week in September, and September historically has averaged. It's been down I think 1.2% per month, and we're down 4.3%. So the market's discounting a lot. So September is typically the worst performing month, and if you're down on average 1.2%, we're down 4.5%. That's we're pretty stretched on the downside. So that's something, anecdotal information that you should be aware of. When you look at this on the weekly, it doesn't look, ominous at all. When you look at the averages, when you look at the monthly, even better. But yet, when you look at the daily, recognize that we just had a 16% drawdown. And that 16% drawdown was pretty nasty. And, it took everything down with it. We got the sharp rebound back, which with a number of follow-through days. I just have a couple of follow-through days listed here, but we actually had two other follow-through days up here as we broke above the 50-day. So that's, with that momentum increase there, we also almost had a breath Marty's wide buy signal as well. We got within just tenths of the AD line, not quite making it to get us in a full-fledged buy signal. So you've got competing forces here, but we definitely have some risk here, but on the downside. But that's assuming that we take out the low 2 days ago, and we'll see. I mean, if we take out the low 2 days ago on the indexes, which is right there, that's going to lead to some selling, and we'll probably have a number of our stops hit. But if that's the low right there 2 days ago, it's setting the stage to have a magnificent rebound from here that can go even further than we think. But we'll just have to see what the tone of the market is. We'll have to see what where the institutions are, if they'll come into the market or not. So we'll take a look. Let's take a look at. We're going to take a look at two portfolios that we have. These are our positions right here. So you can take a snapshot of this, and we think that we have what we think are some of the leaders in the market, and we'll just go through a number of these. Okay, Eli Lilly. you can see Eli Lilly is right here at the 50-day. So this is, of course, what has fueled their gain, this year has been the weight loss drugs, and Mounjaro has been, of course, one of the biggest selling drugs in America. I think they sold $3.5 billion worth of Mounjaro, much more than Ozempic, which is developed by Novo Nordisk. But you're sitting here at a prime position here at the 50-day, where it's gotten real tight. So you're about to see this break one way or another, probably tomorrow. It's going to respect this 50-day, or you're going to take out today's high tomorrow and resume the uptrend. If that in fact occurs, it would be reasonable to buy this stock, taking out today's high and then press it going above 972. So it's really setting up, quite nicely here. And this is really somewhat of a cup and handle. And, we've got the handle forming right now in this pull back here. So, this is obviously a blue chip stock. You can see the numbers. Earnings are going to be up 157% this year, 38% next year. Almost $1 trillion company, and of course, a blue chip stock. But look how it got just crushed. When we had that 16% pullback. So this is what's sort of going on in the backdrop. The market has been, the index has been correcting, but this is only coming down to the 50-day. And it's certainly in an uptrend. The 10 days above the 21-day, 21 days above the 50, and it's at the 50-day. So we are very high, on Lilly. This is Taser next, Axon Enterprise, and this is really what you want to see. You want to see the stocks that broke out on big volume and that consolidated. And now they're right on the cusp of making the next leg up. So this stock came in today a little bit, and as it builds out this right side, this looks quite attractive. But notice the relative strength. Relative strength is 94. It's got this blue dot indicator that means that it's broken out of a base, and it's setting up for, again, the next leg up. So when the market dropped 16%, this only came down to the 21-day. So that's telling you right there that that this is a leadership right now, a leadership position. So again, this is setting up beautifully. So that from a trading perspective, if you can take out today's high, or if we have an inside day, or if you stay above the 10-day and the 21-day, maybe we have a flat day tomorrow, and it just gets tight. But when you take out this resistance here, it's going to be game on, and you can, like a trader would press that position right there, and then at 378.89, you would add to the position. So a number of these positions that we have, we're right on the cusp of pressing them, getting really long in them, or selling them, depending on what happens to them from here. But this is the type of action that you want to see in leading stocks. By no means, and we'll look at some of the stocks like Google and Amazon, that's not where you want to be. Costco, this is a beautiful setup here. So this stock actually made new highs only 2 weeks ago while the market, again, pulled back. This is a 16% correction in the averages, came all the way back. Now you're going sideways. So this is certainly one of the blue chip leaders in the market today. And we're all familiar with Costco and what they do. So this is setting up, as well. A short ninja, which is actually, they're one of the biggest suppliers to Costco with their products. Short Ninja made a new high 4 days ago. See, this doesn't look like, this looks like a leader. It doesn't look like Google, which you don't want to own. Look at that through the 200-day. You don't want to bottom fish here. You want to buy what we think the stocks that we're showing you. That's what you want to buy. You don't want to buy Google. You don't want to buy Amazon. You don't want to buy, these stocks that have been just, crushed. Tesla is coming back. But you've got this overhead resistance with this stock, but it's a relative strength now. It's 81, but it's showing a little bit of life right here. But you don't want to buy the lagging. We don't want to buy the lagging stocks anyway, because we're buying those stocks. You're not going to be Google and Amazon. They're not going to double anytime soon. Where some of these other stocks have much more upside. We do own Meta, which this is the strongest Mag 7 stock. And so you can see here in a setup like this, when you look at it and, you look at it very, very close, and we actually have a stop below that low right there. So you can see we have some alerts right there. So you're right on the cusp of going one way or another. So, if the market cooperates, you can see this stock have, a positive reaction tomorrow, or, you can take this low out 2 days ago and you're going to get kicked out. And that's what we're expecting. You're sort of at the danger zone, which is really the most impactful and rewarding trading scenario that can unfold if that happens to be the pullback low. So
Roy,
yeah.
Roy, if your stop gets hit, do you automatically sell it, or do you wait to see where the close is by that end of that day? Does it?
We'll sell it. We'll sell it right there.
Okay.
So we will. We're planning on selling it. If that happens, but there's no there's no downside. Just in terms of percentage downside, not much. You don't have much downside here at all.
Very little risk there, I see.
Yeah, very little. A $500 stock, you might have, a 0.5% risk right now in it. Now, this is a stock. This is the parent of FanDuel, and this really got our attention here over the last month. And, FanDuel, big gambling site. We're in the NFL season and college football season, so we know business is exploding. Look at the numbers right here, guys. Earnings are going to be up 400% this year, 47% next year. And they just reported a great quarter. And, we just bought this stock yesterday, taking out 215.19 on the breakout. So, we're looking tomorrow, if the market will, cooperate, but regardless of if, quote, the market doesn't have to be up for these stocks to work. They just need to be trending right. There's a good chance that we'll increase our position in this stock tomorrow. So you've got this perfect breakout, and notice here's your catalyst. The catalyst was the earnings report, and the earnings report and the reaction on big volume. Now the stock hasn't given anything back. Now it's starting the next up leg. So it's going into 52-week high territory. So it's making a new high, not a new low, which is important.
How does the weekly look on that one, Roy?
Pardon me?
The weekly on Flutter is it a huge bit?
Man, this really looks good.
Oh, look at that.
This looks great. You have this long base, and and really what's got this thing going is it's had a spotty earnings performance when you can see over here, but this year and next year, it's going to be, tremendous in terms of, earnings projections and so forth. So you've been building a base here for, over a year. So this is just like, and look at long term, this is a 4 or 5 year base. And
Great.
even more impressive is when you look at it on the monthly. And when you take out the all-time high right up there, that's when the game begins. So this is really early. You're getting in this position early. The real move takes place when it gets into all-time high territory. So
Hey, Ron,
Way
yeah.
easier to handle than DraftKings.
Go ahead.
the RS line within the base is pretty low, even though it is, so it started the base at a particular point, and it's lower than right now, even though it's hit a blue. It does show blue on yours. It doesn't show blue on mine, but
Oh,
maybe
really?
on the daily, But this is a good time with the so many distribution days, and on Nasdaq the RS is trending low.
Yeah. Yeah, and that's something you want to pay attention to. So here you have the relative strength line while it's still in the base, while we're going through this corrective phase in the market, and this is making the relative strength line. Notice that's making a new high, and those are the signals short term. This is what's going on. See, that's going on while you look at Google, or let's look at the Qs. But here's the relative strength 37. See on Google, and we normally, 95% of the time, we're going to be buying stocks that have 85 to 95 or higher in relative strength. We would never be a buyer here. But if you're a value buyer, then the value buyers, they're trying to decide from the institutional side is this a good setup or not? This isn't a good setup for us because we don't buy weakness, we buy strength. And so you look at the Qs, and there's a trade here. Now this isn't down that much off the high, but look how this has been trending down. And these are the clues that you want to take a look at. Look at when the relative strength line was going up and leading versus now it's, in this corrective phase. So, 68 with a 68 relative strength, that should kick you out unless, you're day trading or you're swing trading for 3 or 4 days or something like that. But while other people they're trying to find a bargain in Micron and ARM Holdings and the SMHs, we don't want to get caught in this downtrend. So, you might think that this is an attractive opportunity, and there's a trade here, but this isn't going. You're not going to get a double. This isn't going from 221 to 400. While we think, for example, like Palantir is going to go from 30 to 45 by the end of the year. We don't, so that's 50%. We don't think this, this has limited. We think this has limited upside in terms of being a leader again. The semiconductor space, it is possible. It's possible that you have a top end, that you have a major top end. And, time will tell. We don't think so, but it is possible. And, stocks peak on good news. And, we think NVIDIA's got a lot more upside, but it's just not the place where institutions are going right now. But, if you're a bottom fish, type of trader, this NVIDIA, you could buy this NVIDIA right here and have a stop 2 days ago, right there. So if I bought this stock, and we actually talked about it because this is the leading semiconductor stock. This is the only one that you need to own. You don't need to own, PI and ONTO or any of that other stuff. You know, you just, NVIDIA is the only one, or AMD. You certainly don't want to own things like this, Micron, trade below all the averages. This certainly doesn't look like it has anywhere to go that's positive, you know, in a short term. But you know, you don't want to, you don't want to tie up your precious capital in, you know, in names like, you know, this. You should be focused on those that have the highest relative strength, because those are the ones that can double and triple. So Palantir is one of our bigger positions, and you can see that this made a 52-week high. Bank of America came out today with a $50 price target. This happens to be Wes's favorite position in the portfolio. And we think they've got a great CEO, and this is a pure play in AI, and it's making a 52-week high. It's finally working. And we tried this several times over the last year, and only until now has it really broken out to new high territory. And we think that now it's got legs. So it just showed itself, in the last, 2 to 3 days. But even when the market was correcting, see, it only came into the 21-day. And that's the dilemma, is that, if you get afraid because the indexes are doing something, that might, you panic and you bail out of, those indexes right when your stocks are like moving into the prime position. You'll miss the leading stocks out there. GE Verona is, this stock looks spectacular. It's an IPO spinoff of GE. And notice the earnings move here. Earnings are going to be up 300% 2024, 80% next year. Notice that they're doing 30 billion, 10, 20, 27, $30 billion in revenues, and making tremendous inroads in terms of their earnings. And, we think this is a $250 to $300 stock by the end of the year. If this market takes off tomorrow, I wouldn't be surprised to see this stock up $10 to $20, just blowing through this resistance and, starting the next leg up. So, this was just total normal reaction, even when we went through the correction. And notice where it popped up to new high territory. So that's where you want to be buying, guys. You want to be focusing on the new high list and, avoiding the Googles and the Amazons of the world, and looking for new names like this that are going to lead, your portfolio, higher. Here's the XBI. And we did own a stock by the name of ALNY, a biotech that had numbers that we got stopped out of a few days ago. But we're high on biotech, but there's so many biotech companies that don't have revenues or don't have earnings, and we would rather buy something that's got earnings or an ETF like this. And so this is setting up quite nicely. See as well, and see where you have, when this market bottomed only at, in the NASDAQ and the S&P a couple of days ago, there's your stop. See right there. And so now this is total normal action. And this is one that you can buy, taking out today's high and then pressing it again at 103.08 as you go through that pivot right there. So this is setting up quite nicely. So, in our view, there's your stop. You leaked a little bit through the 50-day right there, rebounded the last 2 days. And listen, we were holding our breath a couple of days ago, as well, as I'm sure many of you on our call were as well. But, this hasn't done anything wrong, and it's setting up for the next leg up. So, if we get a nice move tomorrow, that could and should be bought, and it should be pressed at 103, and it should go from 103 to 123, a 20% move. And so that's, from 103 to 123, that suggests 25% upside. And pretty much you got 25% upside on all these positions. Home builders, which should benefit from the lower interest rates, unless we go into a deep recession and then people can't afford new homes. But we know that the secular trend here is quite good, and it's quite robust. And this has not done anything wrong, on this pullback. So it's setting up as well where it's building this right side. So, if you get moving, here, I mean, this is a buy potentially tomorrow to be pressed at to be pressed at 121, to press it and then make the move into new high territory. DoorDash, beautiful reaction to the earnings. It's a nice cup, and this is a really pristine cup and handle. And, when you have these cup and handles, remember the pivot points are the top point, in your handle. So this is another potential attractive leading stock that, that's not a technology stock. And let me see if I've got, and we own Spotify. And, look at, this is what's got our attention, guys. And this is why, we're in these stocks because of current and future earnings. Notice Spotify lost money, for 8 years, 7 or 8 straight years. And the stock made a high of $387 over the last 8 years. While they're losing money for 8 straight years. What is the stock going to do if they're going to do $6.50 this year? If earnings are going to be up 300% this year and 41% next year, it's going to be much higher. I don't know if it will or not, but it should be much higher than 387. So this this stock moved into new high territory. The market brought it down. Now it hasn't done anything wrong, and it's right on that cusp. And you've got that's how close your stop can be. That low of, again, 3 days ago. And I guess we don't own this in our core account. We have it in our swing trading account. And another setup here. And what happens when you have these very volatile days, they throw the baby out with the bathwater, and that's what happened with this ON. But the idea that it came all the way back, and now you can see you had an outside day to the upside. This is in prime position again to move higher. So everything that we're just that we're showing you here, these are what we view as many of the leading stocks, in the market, today. And the list that we're focusing on, and we keep this list updated all the time, but this would be like a focus list that we're looking at before we buy something. And we're looking at this IoT that just broke out, Fortinet broke out, Made by Trip, which is setting up beautifully. Clear Secure, that's used at the airports. There's AppLoven, APP, which is the advertising site. There's Kava, which has been everyone's favorite. And we're not in this. We did not buy the stock on the pullback, and it is heavily owned, but we're not quite sure. It's extended now off the 10-day, and everybody's in the stock, but it's got a 99 relative strength. The numbers are really good, and the numbers are actually much better than like CMG and Wingstop and Texas Roadhouse, TXRH. Kava's got pristine, the numbers here are great. Of course, everyone's, lumping this, everyone's projecting that this might be the next Chipotle. You've got a great leadership team. The guy came from, I think, Panera Bread, if I'm not mistaken. So they've got the formula here, on Kava. And of course, the stock's in new high territory. And so this, it certainly doesn't look like the market's been in a correction for, a stock like Kava. And this is the one that Wes and I really kind of we were disappointed because there's your buy point right there when it broke back above the 50-day, and we did not act because the market was in this major correction. And we did not act right there, and so we regret not making that purchase because we certainly were watching it. But when this market got really crazy there, 98 to 72 on the pullback, and then it came all the way back. So it's acting beautifully. That's what you want to see with leading stocks. That's what you want leading stocks, to do. We happen to miss that one. This Melee setting up great. '93 relative strength, and that's the all-time, that goes to all-time high territory. So this is a stock that's going sideways for 4 years, guys. And, the stock that's going sideways like this, that just broke out, this has got much more upside. We don't own this, but it's at the top of our buy list as well. I mean, tremendous numbers. Remember CANSLIM from Bill's work. He insisted on having 25% earnings growth and 25% revenue growth. Well, here you're getting 100% revenue growth, tremendous revenue growth, and big numbers as well. 10 billion versus 5 billion. Those are huge numbers, and it's far surpassing that, that 25% earnings, growth. So this is where you want to be. This is where the leaders are. So you'll find them in the new high list, not the new low, of course, not the new low list. Okay, with that, let's just open the meeting to any stocks you guys want to pull up, and we'll take a look at those.
Any home builders in the list?
We own XHB but you can buy, it's a Lennar and DHI really. I mean, DHI is the largest home builder in terms of, I think, volume or sales. I mean, and DHI is number 2, I think. And this looks constructive. So Lennar, DHI, they look pretty much the same. And again, we're in just the XHB, so we don't have that individual stock risk.
Yeah, it looks like, if we get lower rates going forward, existing home inventory prices aren't going to be likely to go slightly higher. And it seems like the benefactor may be the new home builders. Government wants them to build. There's a demand for them to build. Is anything the charts speak to that?
Yeah, I do. If this chart is not showing you any issue. No, on the daily, they're just so much more volatile when you look at the daily charts and what's going on in the weekly and the monthly. And I think that's important to, that's really important to take a look at. I mean, here, nothing's wrong with this stock on the weekly basis. It's about to break out and go into, again, all-time high territory. But, again, you look at it on the daily and it's, that's pretty, it's pretty volatile. 135 to 118, 136 to 125. I mean, they're sort of, they are moving around there. But you could buy any one of these, your favorite. They're going to all probably perform, the same.
Roy, what do you think of eBay?
I love it. I mean, maybe the credit scare that we're seeing today is, and Wes mentioned about that, about the 20 basis point delinquency rate increase. Doesn't seem to be that much, but maybe that's going to be important to watch because, and this might be a play on that, where if the lower income, the have-nots, the lower income people that are on fixed incomes and are on Social Security, they're the ones that are penalized the most based on what's the policies that we've been implementing, and they've been destroyed by inflation. Maybe this is telling you that eBay, that guys, those guys are going to start selling a lot of their stuff out of their garage, and maybe that's going to, maybe this is suggesting that you're going to have a boom here from people selling things on eBay. But it looks fantastic, looks great, and it's that is in fact telling you something. Look at this on the weekly. It looks quite constructive, does it not? On the weekly, just nice uptrend, nice trajectory there. It looks very good.
Strong RS during the last sell-offs. It basically didn't budge.
That's a great point. That's
phenomenal.
That's a great point. You're right. You couldn't tell that that the market was in a correction. Yeah, go ahead.
Do you prefer a Flute, FLUT, over DraftKings? Flute has a better RS rating, but the DraftKings has better earnings per share ratings.
Yeah, look at this. I mean, this would totally. And actually, by the way, we were in DraftKings, and if you're, when we're looking at this, I mean, I can't remember when we were in it and when we sold it, but there's a possibility that we were in it like, in here when it was making new highs, and we probably got kicked out, maybe like right there when it broke the 50-day. And then you can see it's been in this, downtrend. And so every time it's bounced up the 50-day, it's been a shorting opportunity. So this is the distinction that you must make when you look at your stocks. You shouldn't buy a stock with a 37 relative strength. That is if you're following CANSLIM. I mean, you can trade anything, guys. This is just something. This is what I've learned over the last 37 years. And, and I have had probably a dozen years where I've had triple digit returns, but it's been quite difficult. It's been a difficult market environment, the last, since COVID hit, and the corrections, the move higher, the lack of breadth, the move with, the move up in Mag 7, and the lack of breadth in individual stocks. I mean, it's been a very tricky, difficult market, the last 2 to 3 years. It's been, we had that bear market in 2022 where the NASDAQ dropped 35%. I mean, it's been quite tricky. But, with this relative strength here, 37, there's DraftKings, below the 200-day moving average versus FLUT, which 86 relative strength going into new high territory. See the difference? The chart tells you, all you need to, know. Buy the leader, not the laggard. Buy NVIDIA, not AMD.
So I'm assuming the market is more excited about their projected earnings. Flute has much higher projected earnings this year and the next versus DraftKings.
Right. Yep. And Yeah, they're the biggest. I mean, Flutter Entertainment. In fact, when you look at, they provide the back office. When you take a look at this even further, find out who their clients are, our brands, see FanDuel, Poker Stars, all this stuff. They provide, the framework by which all these companies, sell their services.
Hey Roy, I just want to pick your brain on the leading sectors like
Yeah.
consumer staples and utilities and XLRE. These are not the typical sectors that you have in a roaring bull market. They all more remind me of, big institutions getting a little bit uh, wary about the situation. And then today you also saw WTI oil, dropping, big time. So, are some institutions, what do you think? Are some institutions kind of worried about a potential recessions with, these conservative sectors being at the top and oil dropping down? Any take on that?
Yeah, that no, normally, those are defensive sectors where people that must stay invested, they rotate to because they're, obviously they're afraid. I was just taking a look here on the market. I was looking at the market surge 250 to see the leading groups and see total. Look at this. Definitely defensive beverages. And so, you're going to make your big money in growth stocks, and all the stocks that we've been featuring tonight. You're not going to make big money in Dr. Pepper or Coca-Cola. And, these are defensive groups, beverages, non-alcohol, long-term care. Everyone, needs that. That's defensive areas, the hospital areas. That's been a leading area. Now, mining, certainly it's in the top 10 groups. So that's reflecting gold strength, which is running to the beat of its own drummer. But these are quite defensive. And so the market, and, while the market is undergone this correction, you've had this rotation into these sectors that aren't necessarily sustainable. It's just been a short-term place to hide. Energy was, they had their run earlier, in the year, but these are very, very defensive sectors. And now we do like the power area, the wholesaling of, energy and power that stocks like NEE, specialize in. So, some of these specialized utility companies that sell power are more attractive to us. We actually bought this Vistra, which, they're one of the top sellers of, wholesale sellers of power and electricity, because, we know that all these data centers and that are being built across our country, they're going to require a lot of power to run. And so we actually bought this and sold it, got kicked out right there. We bought it as it came back above the moving average, and we ended up buying this stock like probably right in here. And this was this was a leading stock earlier in the year, had this big correction, and then we thought that, okay, now it's going to recover and make the next move. And so, when you're looking to purchase, your best place to purchase are above your moving averages. You can see here that, and that's when, the market got hammered right down there. And, you might say, well, I missed it. I missed it down here, but you're not looking for the cheapest price. You're looking at the best price where it's going to work. And, this is one that we were following, along with things like CEG, which was a big alternative energy leader. And that,
Have a look at SO, Southern Company. That's a strong one.
Yeah, I mean, so this, I mean, this looks, looks great. But this is kind of this may or may I like this certainly much better than like buying Coca-Cola or Dr. Pepper. So, these are defensive that that defensive stocks that pay dividends, but they do have that growth attribute that's out there. And that growth attribute is the generation and resale of electricity that we're going to need. This GEV that we have, they're in everything. So, when you take a look, at their website and you learn about their company and the businesses that they're in everything. In fact, I think this is one of the largest. They're the biggest players in providing electricity in the world. I believe that.
I've come across the situations where some of these more defensive stocks, like for example Costco or right now Walmart or even Procter and Gamble or 3M, once
Yeah,
they get that momentum, they can move and they don't
yeah.
stop moving. So or a PM like a Philip Morris, have a look at PM. It's like insane what they do. So just because they are defensive doesn't mean they can't have a run. You know what I mean?
I do, and quote, every dog has its day. I just don't think, and of course, I mean, look at this. Who would not want to be in, some of these, and and you get your, 10 to 20% move, and so that's what's happened. I would expect a rotation, by the way, out of all this. So if this, if this market turns on the, if this market turns on the averages, you're going to see money flow into, a lot of these stocks that we own plus technology, and you can see this correct. And so, I mean, you're right. This is like, it's pretty extended. Philip Morris paying a dividend, place to hide. This would be something that I would expect to, sell off. Guys, we only have about 8 more minutes, so just wanted to give you a heads up before the debate starts. So,
Could you give your opinion on the Celsius? It has earnings power, but for some reason it is not reflected in the stock price. If you look at the earnings table, CELH.
it's we were. This is one of our favorite positions. This is one of our favorite positions too. But look what happened right there on the break. And so and the numbers were, the numbers are coming down, but they had triple digit numbers. And the numbers were even better going back a couple of more quarters. But MarketSmith doesn't have it on this chart. You can't see it on this chart. But this had terrific numbers, and now they had triple digit numbers. And look at the numbers now. Earnings are going to be up only 12%. And so numbers have been ratcheted down on the stock. And notice the relative strength of 5. This is the danger of buying something thinking that it's getting, that it's cheap. That if I liked it at 100, I like it at 80. Well, I like it at 70, 60. 50, 40, 30, you like it all the way down. That's why you have to be careful. We just got kicked out of this TMDX a week ago, and this stock, has a formidable, it's a formidable company, has a great business plan, great triple digit numbers, earnings up 900%, 500, 900. But look at the break, and we sold this. We sold this right there, and we sold it, and we let the market tell us when to get out, because we don't know if this turns in. I was remarking to Wes, we don't know if this is going to turn into a Celsius. I mean, organ transplant business is big. They've got a huge business. They'll be all over the world eventually. You've got triple digit numbers, great research, very conservative management, but it's not acting right. So that's clearly not a normal reaction. So you've got to be careful with those like Celsius and TMDX. And, buy them on the technicals and fundamentals, but you must sell them on the technicals.
Proprietary solution, which they kept closed source, while everyone else tried to define it.
So the person who asked about Celsius, there is a lot of information on the web, but primarily slightly different agreement with Pepsi. In this case, Pepsi actually buys the quantity, orders the quantity and buys it. It is not just distributing it, and they mismanaged the shelf space, and they ended up ordering $100 million in orders less, and that just brought down Celsius.
So, unless you're an insider and, have access to that, you never know, but the stock tells you. See, something happened here with, again, we're looking for stocks that go up big, that have a good reaction, that go up, say, 10% on the earnings report, and, where volume explodes. This went just the opposite. So big outside day here on that day, 17 million shares, all down, that was your sell signal to get out, that right there. And, it's going to, that stock's, obviously this stock may have made an important all-time high, until they somehow rebuild their brand again.
Wes, I had a question between this one, Market Surge and TradingView. Do you use both? Do you prefer one over the other?
We use, we run screens. We have all types of screens that we run here. So we prefer, Market Surge. So we run all kinds of screens. You can see these are just some of them that we run. And then we have other, screens that we run down here as well. So it's quite good. Like we run all these screens here.
Wow.
As well. But, all those screens are, we run all those screens, and hopefully what we're, again, what we try to do in these meetings tonight is give you, be a short-term resource, be a resource for you guys to point you in the right direction, because we're going to be in the majority of the leading stocks out there. And again, we just covered, we covered 20 that we think that have great setups, right now. And, this is the market. We'll just see what the market does. But, we're very close to being at support. All these can make, they can make a next, new leg higher. I think they have much more upside, not just 5 or 10%. I mean, we think these stocks go up 50. A number of these stocks, they're going to double, they're going, a number of these are going to be up 100%, 12 months from now. We just, we hope to, we hope to ride a few and not get too many bucking Broncos out there.
Do you subscribe to Jim Ropel, and do you find it useful?
We have subscribed to Ropel, and we like him. We like Ropel a lot, but he's a little bit. He just seems to be way optimistic at the top. He's always bullish at the top, bearish at the bottom. And he follows the same stocks that we follow as well. And he's got a hedge fund, and we're very aware and in tune what he owns. We communicate. We communicate on Twitter, Jim and I, occasionally.
Thank you so much.
We follow Mark Minervini quite quite closely. He's a friend of ours. I actually spoke at his annual gala last year. I was one of his featured guests last December when he does an annual event.
Yeah.
And I was one of the speakers, one of the panelists, the guests. But we think highly of him. Love his books, and he's really helped me, over the last 10 years. We think he's one of the best out there. But he doesn't manage money. He just provides information, and he's expensive. But we are subscribers to both Ropel and Minervini.
Thank you.
When was the last time you invested in energy?
In what?
In energy?
It's been a while. It's been a while. XOM. It's been a while. There's Exxon, CHV, or CVX. It's been a while. And we don't think that you've got the sustainability of the earnings power that you're looking for something like this. Look at the relative strength, very poor. So this just isn't, it's not our cup of tea. Relative strength, I think that's a 7, on Chevron and Oxy and all this. I mean, what this might be showing you is that earnings, they're going to just flood the market. If Trump's elected, he's going to drill, and they're going to flood the market. Oil prices are going down. Margins are going to go down, and all that. Maybe that's telling you right now. So, guys, with that, look, we're going to go ahead and end the meeting tonight. It's 9:02. The debate starts probably in the next couple of minutes. And, again, thank you for attending tonight. We look forward to seeing you next month. You can follow up to Wes and I, if you got any other questions. And we thank you for attending tonight, and we hope you have a good evening.
Thank you, Roy.
You're welcome,
Thank you
guys.
very much.
Go get them. Get some of these winners. And we'll get the slide deck out to you in the next 2 days.
Okay, thank you.
You're welcome, guys. Enjoy the debate.
Bye-bye.
Bye-bye.